Powell did his Jackson Hole speech, basically admitting that they're ready to pivot. Sounds like normalization versus accommodation. But Craig, let me turn it over to you and have you give your high-arching view of what's next, why they did what they did, and where we go on their data dependency and all things macro event risk.
This short clip is presented by Hedge. Hedge is our pro-to-pro advisory service, which is all about the macro with a focus on one-to-one engagement with the hedge fund manager, Craig Shapiro, economics advisor, Jeffrey Fouvry, and direct access to LaDuc Trading founder, Samantha LaDuc. For more information about Hedge, visit www.laductrading.com/edge.
The speech the Fed chair gives every year, it doesn't always have fireworks, but clearly it's a seminal moment in the year where all the central bankers are getting together and something can be said. And 2 years ago when Powell gave the speech, markets were rallying in an inflationary way, and he apparently, rewrote his speech, did an 8-minute speech where he's like, pain will be needed and we will get inflation down, and the markets really kind of revolted, on back of that. And so here we are 2 years later, and the market had become very sanguine and complacent about what he would say, which is basically that, rate cuts were coming and mission completed. And, that was heavily priced into today. And he took the pitch and he really hit it. He hit all the dovish notes, and it was way more dovish than I thought it was going to be. Frankly, I thought it was more dovish than it had to be. And it's not really clear to me exactly why he felt he needed to be so dovish. If you recall, the last Fed meeting was 3 weeks ago, right? And so
what's changed?
3 weeks ago when he was asked, first of all, they didn't cut rates. And we learned from the minutes this week that several members, which is, greater than 3, but less than half. So call it, 4 or 5 or 6 members would have embraced a rate cut at the July meeting, but decided not to. So subsequent to that, what we got was a labor print, which was in, the first week of August for July, which was worse than expected. Not horrible, but certainly worse than expected. We got an inflation print, which was basically kind of in line. We've gotten several weeks now in a row of initial claims, which have been basically very, very steady. We just had a services ISM print, which I think was one of the highs for the year, so decent. We had these labor market revisions, which I don't really think are that interesting, but we obviously had a very big negative revision. But people knew this was coming, so we knew that the labor market wasn't as strong as kind of initially perceived every month when we deliver the data. But I don't think that really changes much for the Fed. And when you listen to some of the Fed speak this week, they said it really didn't change much. Here we are 3 weeks later, and Powell came out with various very dovish statements, and I'll just read a couple of them. The time has come for policy to adjust. Not surprising, we're already pricing in 100% odds of a September rate cut. This was the big one, though. We do not seek or welcome further cooling in labor market conditions. So that's like Draghi, whatever it takes moment.
I thought so too. I literally texted that. Tweeted that.
It's not really clear like why he felt the need to say that at this point in time. Again, 3 weeks after they just spoke, 2 days after they released the minutes. What changed? What is so much worse now than what they saw then? So we'll figure this out over the course of the next few weeks. Are they seeing a substantial deterioration in labor market conditions? They'll give the beige book in 2 weeks. Maybe that'll show some qualitative assessment from business contacts that are saying, yeah, things are really slowing like much more rapidly now than before. Or was he given sort of the tap from Yellen and the powers that be inside DC who are saying probably be better like if we didn't have a recession start like right into the election, deep state type of stuff. We don't want Trump, and let's not piss voters off by having a recession and a correction like right now, so get more aggressive. I don't know, it struck me as bizarre that it was so aggressive in the language. It was very forceful. And that was even after a few Fed members this week were saying things like gradual and methodical rate cuts, which I think means 25 a meeting or whatever. And we had a speech from Bowman, and she is the most hawkish member, earlier in the week. And she's basically like, and Schmidt as well, who's not a voter, basically like, we're not really even supportive of a rate cut. So Powell clearly wanted to get out there and basically start corralling the cats and make sure that everybody kind of gets in line. But the question that he didn't really address is whether or not he feels like this economy needs accommodation, or if he feels like the economy just would benefit from rates falling in a more of a normalization type way, kind of as, you know, and that inflation's fallen. If we don't cut, then we're getting incrementally more restrictive. So we need to do normalization cuts. Now, look, the market obviously is very aggressive in its expectation for cutting. Basically assumes we'll get back to neutral rate, which let's say is about 3% by almost a year from now, which is almost 2 years ahead of when the Fed would have said that they would get back to neutral. The market is ripping through this and saying, we want all these cuts now, imminently. And we'll see how the Fed, if and when the Fed pushes back against that. But as of right now, what the market did today was basically say, yeah, it's great. We don't really know if the economy is slowing so rapidly, but we don't really care because the Fed's just going to give us a lot of cuts real quickly and things are going to be great. Now, my initial reaction to that was he's going for the debasement. He's basically saying,
currency debasement.
Yeah,
the currency easing.
He's basically saying, look, I know the S&P is only 1% off the all-time high. I know credit spreads are basically record tight. I know inflation is not back to 2%. It's still above 2.5%. And I know unemployment, although it's come off the bottom, is still very close to maximum employment, right? 4.2%, 4.3% would have been considered maximum employment in America, like for the last 50 years. So, you add up all those things and I'm like, and this guy's basically saying we need to like panic into rate cuts. My first thought was, okay, dollar's going to get rinsed. Gold's going to rip. Store value assets are going to rip. Bitcoin, commodities. And look, as far as stocks are concerned, clearly on a day they're gonna go up in initial reaction. But I found it interesting. I mean, look, gold. I mean, certainly Bitcoin was the best performing asset on the tape today. That doesn't really surprise me. But gold outperformed, basically performed in line with S&P. Do you want to really own stocks that have earnings risk? If things are as bad as what Powell I think is intimating, then there's an earnings headwind coming in this economy. And so do you want to own stock in that environment versus owning store of value assets? My choice was I'll just own the store of value assets. I don't need to own stock. But obviously everybody decides to do differently. But from here, I think the question is, will the data slow more protracted way, which is going to kind of force them to go earlier? Or is it just going to slow kind of gradually, in which case, like the soft landing is assured and everything's going to be fine? I mean, my view is the data is rolling over. Data is going to get worse over the course of the next 2 to 3 months before it gets better. And so I think that
you're bullish rate cuts.
Yeah, look, it was one of those weird things where it's like I felt like the Fed should be cutting rates aggressively because I think things are rolling over, but I didn't think they were going to do it as aggressively as maybe Powell is intimating today, because they have said things in the past about gradual, methodical, and needing to get inflation further down. But this seems to me like a more aggressive pivot by Powell than I was expecting. So again, it's either because the Fed is finally realizing that the data sucks, which is possible, in which case all equities, particularly the most cyclical, I mean, the best performing subsector today was unprofitable technology, right? Like, is that what you want to own if we're going into a growth slowdown and a recession? I don't think so.
I thought about that though, just a little bit. It could be a wee bit of that hedge fund factor rotation.
Oh, no, for sure. It was that.
All of them.
Absolutely. So again, the first 24-hour reaction in 48 hours, like we'll see, but kind of thinking about this through the end of the quarter and maybe even into the election, is that really what you want to own? I don't really think so. Now, do you want to own commodity exposures when you're in a dollar debasement concept? Yes, but I think you want to own precious metals over cyclical metals or even energy. Now, I think you can own these things for a trade, but if growth is going to slow down, I mean, I put a chart in our chat about export order growth across the world is plummeting over the course of the last 3 months. I mean, so the global growth momentum is not particularly good. So I don't really view this as a time to be allocating into cyclicals. Now, again, though, today, back to that factor rotation, I mean, the worst performing sectors today were utilities, staples, and healthcare. Why? Because they've been the best performing sectors.
Yes.
And so even though bonds were rallying, those things underperformed. It's like the market kind of shifted in a way from I want safety to I actually want like inflation hedges. So we'll see if that lasts into next week. But
one exception, home builders went hot fire flames.
Right, because home builders are cyclical, right? They benefit from both, right? They're the double winner, right? They get if rates are going down and cyclicals are in vogue, then you want to own. Then that's your that's your high beta way to play that. Again, is that going to work? I mean, I don't know. They're at the highs. I'm not sure, but I don't know. It's a bizarre setup. For me, the most comfortable thing when I step back is say this Fed is more concerned now about a growth deterioration. I'm seeing more evidence of growth deterioration. They are going to be cutting rates more aggressively than they thought 3 months ago when they gave the dot plot. And that's going to lead to lower yields around the world. And it's going to lead to a lower dollar. And it's going to lead to higher inflation expectations. And it's going to lead to, I think, a higher gold price. And the question is, can those lower rates actually lead to a growth acceleration again? And is this really just some sort of mid-cycle pause that we've had over the course of the last few months and the lower rates are going to help? Or is this something more sinister and growth is really slowing and low rates are a gradual move to a lower rate regime isn't going to be enough to arrest that growth? I think the jury is still out. And then we have to think about some of these unwinds still, right? I mean, dollar yen is nearly back to the lows from 2 weeks ago or 2.5 weeks ago. I mean, BOJ was in Parliament last night and basically said, we're probably going to keep hiking rates. And so if you think about this, the forward expectation
is cheap.
Yeah, but the forward expectation is that the Fed is going to be way more aggressive in cutting than the BOJ. So that there's a lot of room for dollar yen to continue to fall. And if the DXY moves through 100, then for years we've had, at least for the last 2.5 years, DXY above 100, you've had foreigners who felt very comfortable investing in the US, investing in US assets on higher yield, higher growth, US tech. If the dollar is going to break down because the Fed is going to be cutting rates aggressively and growth is slowing, you may see that capital fly out of the US, and that's going to be a headwind for US tech and US stocks. So a lot to think about, a lot to digest from today. Definitely was surprised in Powell's speech, and it's a question of, is he trying to get in front of the slowdown, or is he already seeing it? And they're finally willing to kind of admit it more publicly. We don't really have all the answers, and we get not a lot of data next week, but the week after is we get all that payroll data and the ISM. So that'll be the real tell.
The full episode is available to Edge paid members. For more information, visit LaDucTrading.com/edge.